2 or 3 losing trades can sink any account. The solution isn't switching strategies, it is building a clear framework for risk position sizing and knowing when to stop trading. With a solid framework, account volatility is controlled and the risk of margin calls is minimized. Before every trade, answer 4 questions. What's your fixed risk per trade? How will you size your position using a formula? Where is your volatility-based stop loss? And what are your daily or weekly stop rules? These 4 pillars reduce pressure and keep a few mistakes from pulling your account into danger. The 9-step anti-margin call plan is: first, convert risk into R. R is the distance from entry to stop loss. So set the monetary risk for each trade at 0.5 to 1% of equity and evaluate all outcomes based on R. That way trades stay comparable, decisions remain objective, and you avoid focusing on the crash value. Second, position size based on formula, not intuition. Use a formula for your position sizing. The risk amount divided by stop distance times value per point. If the answer feels way too big or way too small, the problem is with your stop or leverage, not your confidence. Third, stop loss based on volatility, not obvious levels. Placing stops right at obvious levels, highs or lows, is asking to get stop hunted. Use the ATR from the same time frame, typically 1 to 1.5 times ATR, so your stop sits behind normal market noise. If market structure shifts, combine structural stops with the ATR filter. Fourth, risk cap for the entire account. In other words, total open risk across all trades should be under 3% of your equity. Also, avoid stacking more than 2 trades in the same direction on a single idea, like strong dollar, to prevent hidden correlation from wiping you out. Fifth, margin level management is important. Keep your margin level above 500%. If it drops with 2 positions open, either the position sizes are too large or the leverage is disproportionate. A quick fix is to close part of the volume or have the size of subsequent positions halved. Sixth is timed pauses to manage your tilt. The daily rule is if you're down 2R or 3%, stop trading and review. Your weekly rule is if you're down 5%, stop until the week's end and focus on reviewing and practice. Survival matters more than winning it back today. As the 7th part, minimum risk-reward ratio. So skip setups below 1 to 1.5 and aim for an average of 1 to 2. With a 45 to 50% win rate at 1 to 2, your equity curve can withstand losing streaks. 8th is stepwise scaling, both up and down. After 2 consecutive wins, increase your size by 10 to 15%, and after 2 consecutive losses, cut your sizes by 30 to 50%. This smoother scaling makes your equity curve steadier. Finally, protocol around high-risk events. So, around NFP and CPI interest rate decisions and news with price gaps, you should either stay out or reduce sizes, use ATR-based stops, and set conservative targets. Your price slippage can impose a cost beyond the normal stop. Common mistakes that lead straight to a margin call include averaging down without an exit plan, moving stops out of hope, overloading correlated trades, scalping with high spreads and commissions, and increasing size after a loss to win it back fast. None of these give you an edge. They all speed up a margin call. For example, let's say your equity is $4,000. Your risk per trade is 1% and that's $40. On gold USD, your stop is 1.2 times ATR, about a $3.50 move. With a 0.1 lot, every $1 move equals $10, so the stop costs about $35. That means your optimal size is around 0.11 lots. With 2 trades open, the maximum total risk is 2%. If the margin level falls below 600%, no new trades until one is closed. Capital management is the art of limiting bad luck and extending the life of your statistical edge. With fixed risk, formula-based sizing and ATR stops, account-wide caps, as well as timed stop rules, the chance of a margin call drops sharply and your account growth becomes steadier. If you want a personalized plan, send 3 details: your current equity, your main trading instrument, and your average stop distance. Based on that, we'll calculate your optimal position size, your account-wide risk cap, and give you a daily execution checklist. Ready to start? Let's go and do it.